welcome back to another edition of Intelligent Investment Today. This is the podcast where we explore financial history, market psychology, and the timeless principles of value investing. Because while technologies change, industries evolve, and the names on the stock ticker may be different, human nature remains remarkably consistent. And today we're going to explore what I believe anyway is a rather fascinating comparison between different eras. We're going to compare the current boom in artificial intelligence and the great speculative mania that preceded the global financial crisis of 1873. Now, at first glance, these two periods may seem completely unrelated. One involved railways, steel, telegraphs, and industrial expansion. The other involves artificial intelligence, semiconductors, cloud computing, and machine learning. Different centuries, different technologies, different economies. But underneath the surface, there are some striking similarities. Not necessarily in the technologies themselves. Rather, the similarities that lie in how investors behave when they become convinced they are witnessing the future. Because history teaches us something very important. A technology can be revolutionary and still become the centre of a speculative bubble. In fact, some of the greatest investment bubbles in history have formed around technologies that genuinely did transform civilization. And that distinction is one investors often forget. So today we're going to examine the boom that led to the crisis of 1873, compare it with today's AI enthusiasm, and explore what lessons value investors might draw from both periods. So let's get right down to it. As always, sit back, tune in, and get ready to take on board another lesson in value investing as inspired by Benjamin Graham. Let's take a journey back through history to the decades leading up to 1873. The mid-19th century was an extraordinary period of technological progress. Railways were spreading across Europe and North America. The telegraph was revolutionising communication. Industrial production was accelerating. Global trade expanding. New financial markets were emerging, and investors became captivated by the possibilities. To many people at the time, railways represented the future. And of course, in many ways, they were right. Railways transformed commerce, reduced transportation costs, connected cities, opened new markets, and fundamentally reshaped economic activity. They were one of the most important technological developments in modern history. Now I ask, does this sound in any way familiar? Because today, many investors say similar things about artificial intelligence. AI promises to improve productivity, automate tasks, transform industries, create entirely new business models, and in doing so, potentially reshaping the global economy. Just as railways altered the industrial world, AI may alter information technology. The technology itself may indeed be revolutionary, but of course that doesn't automatically mean every investment connected to it will be successful. One of the most important lessons from the period before 1873 is that investors gradually stopped distinguishing between good technology and a good investment. The railway industry became the dominant growth story of the era. Capital flooded into railway projects. New lines were proposed constantly, and investors became convinced that demand would continue expanding indefinitely. Governments encouraged this development, banks extended credit, speculation accelerated, and eventually enormous amounts of capital was allocated to projects that never should have been funded. Because when enthusiasm becomes extreme, standards often decline. Projects that would have been rejected under normal conditions suddenly receive financing. The risk appears less important, and investors begin focusing almost exclusively on potential upside. This is one of the recurring features of speculative booms throughout history. The excitement surrounding genuine innovation eventually spills over into less deserving opportunities. Now let's consider today's AI landscape. Artificial intelligence is clearly generating extraordinary enthusiasm. Companies seemingly can't stop talking about it. Investors are scrambling to identify future winners, and valuations in certain areas of the technology sector have expanded dramatically. Capital is flowing into anything perceived to be connected to the AI story. Now, this does not necessarily mean AI is a bubble, nor does it mean the technology lacks substance. Indeed, the technology may well become one of the defining economic developments of the 21st century. But history suggests that transformative technologies often attract speculative behaviour precisely because they are transformative. Investors tend to become so focused on the size of the opportunity that they begin paying less attention to price. And in investing, price always matters. This was a point that Benjamin Graham repeatedly emphasised. No matter how exciting a business may be, no matter how promising its future, the investment must still make sense relative to the price being paid. Because even extraordinary businesses can become poor investments when purchased at excessive valuations. And this is one of the great dangers during periods of technological excitement. Investors stop asking, "What is this worth?" and begin asking, "What if this changes everything?" The second question may be fascinating, but the first question is the one that determines investment returns. The years leading up to 1873 also witnessed another familiar phenomenon: leverage. Credit expansion played a major role in fueling railway speculation. Banks and financial institutions provided financing. Projects multiplied, asset prices rose, and rising prices encouraged further borrowing. For a time, this created a powerful feedback loop. Success appeared to validate the optimism, but eventually, reality intervened. Some projects failed to generate expected returns. Credit conditions tightened, confidence weakened, and the entire structure became vulnerable. When the crisis finally arrived in 1873, the collapse was severe. Bank failure spread, and what became known as the Long Depression followed. Now, it is important not to force historical comparisons too far. Today's financial system is very different. The structure of modern AI investment differs significantly from 19th century railway financing. But the broader lesson remains relevant. Periods of extreme optimism often encourage investors to underestimate risk. And risk does not disappear simply because a technology is transformative. Another fascinating parallel involves infrastructure. During the railway boom, investors often focused on the companies building the infrastructure of the future. The tracks, the networks, the physical systems that would support economic growth. And today, we see something similar in AI. Many investors are focusing on the infrastructure providers, the semiconductor manufacturers, the data center operators, the cloud computing providers, and the networking companies, the businesses supplying the tools necessary for AI expansion. Again, this does not mean these investments are poor. Some, no doubt, will become enormously successful. But history reminds us that infrastructure booms can sometimes create excess capacity, too much investment, too much competition, too many participants chasing the same opportunity. And when that happens, even important industries can produce disappointing investment outcomes. One of the great ironies of financial history is that technological success and investment success are not always the same thing. Railways changed the world, but many railway investors lost money. The internet changed the world, but countless .com investors suffered large losses. The automobile transformed transportation, but hundreds of automobile companies disappeared. Being right about the future is not enough. You must also be right about valuation and the economics of the underlying business. This is why value investing places so much emphasis on analysing businesses rather than stories. Because stories attract attention, but economics determine outcomes. There's also another important lesson from past technological revolutions that investors should keep firmly in mind. When a new technology emerges, there's often a tendency to assume that every company participating in that technology will prosper. But history suggests otherwise. In reality, many revolutionary industries eventually become dominated by only a handful of major players. Sometimes only one. Consider internet search engines. In the early days of the internet, there were dozens of competing search platforms. Companies came and went. Investors could easily have convinced themselves that search was the future, and they would have been dead right. Search became one of the most important functions of the internet, but being right about the future of search was not enough. The critical question was which company would ultimately dominate the future. Today, most people use Google. The search market did not create a dozen equally successful giants. Instead, the economics of the industry heavily favoured a dominant player, and many of the early competitors either disappeared entirely or became shadows of their former selves. The same pattern has appeared repeatedly throughout business history. The automobile industry once contained hundreds of manufacturers. The airline industry saw countless entrants and failures. Railways themselves experienced waves of consolidation after the speculative excesses of the 19th century. And it is entirely possible that artificial intelligence may follow a similar path. Today, investors can choose between numerous AI platforms and ecosystems. There is OpenAI's ChatGPT, Microsoft's AI initiatives, xAI and Grok, Google's Gemini, and Anthropic's Claude, and likely many others still to come. But does the world really need 6, 7, or 10 large language model providers of roughly equal scale? Perhaps, but history suggests that many technology markets eventually become concentrated around a small number of dominant platforms. This comes about through network effects, scale advantages, brand recognition, and distribution. And this often creates a winner-takes-all, or at least a winner-takes-most dynamic. The challenge for investors is that nobody knows with any degree of certainty who the eventual winners will be. Will ChatGPT become the dominant consumer AI platform? Will Microsoft's integration into enterprise software prove decisive? Will Google leverage its enormous distribution advantages? Will Grok find a unique position? Or will some future competitor emerge that barely registers on investors' radar today? Nobody can know. And that certainly is precisely where value investing becomes useful. Because when investors become convinced they know who the ultimate winners will be, they often begin paying almost any price for that belief. But history teaches humility. The future may well belong to artificial intelligence. That seems increasingly plausible. What remains far less certain is which companies will ultimately capture the majority of the economic value created by that future. And those are two very different questions. The investor who confuses them may discover that being right about the technology is not necessarily the same thing as being right about the investment. Let's consider another lesson from 1873. Speculative booms often create both winners and losers. The public tends to remember the technology. They remember the railways, the internet, the automobile, but they often forget the enormous numbers of failed enterprises that emerged alongside the eventual winners. And this is something worth remembering during today's AI enthusiasm. Artificial intelligence may become ubiquitous, but that does not guarantee that every company associated with AI will prosper. Some firms will likely dominate, others may disappear entirely, and distinguishing between those outcomes is rarely easy in real time. This is where patience becomes particularly valuable. Value investors do not need to predict every technological trend perfectly, nor do they need to identify every short-term winner. Instead, they focus on business quality, competitive advantages, financial strength, cash generation, and of course, valuation. If AI creates durable competitive advantages and sustainable earnings growth, those benefits will eventually appear in financial statements. And when they do, investors can evaluate them rationally, without relying solely on speculative projections. There is another important similarity between the railway era and today: the fear of missing out. During the railway boom, investors worried about being left behind by industrial progress. Today, many investors worry about missing the AI revolution, and this fear can be incredibly powerful because no one wants to watch transformative change happen from the sidelines. But the fear of missing out is rarely a sound investment strategy. It encourages rushed decisions, reduced discipline, and excessive focus on short-term momentum. The challenge for intelligent investors is remaining open-minded about innovation while remaining disciplined about valuation. And that balance can be difficult, but it is essential. So as we begin to wrap things up, it's worth reflecting on what financial history actually teaches us. The lesson of 1873 is not that technological innovation is dangerous, nor is it that investors should avoid exciting new industries. The lesson is that revolutionary technologies and speculative excess often arrive together. Railways changed the world, but speculation still occurred. Artificial intelligence may change the world, and speculation may be occurring today as well. These ideas are not mutually exclusive. A technology can be genuine, a revolution can be real, and valuations can still become excessive. And this is perhaps the most important lesson of all, because investing ultimately requires separating the quality of an idea from the price being paid for it. And history repeatedly shows that investors who fail to make that distinction often pay a very high price. And that brings us to the end of today's episode. A look at the railway boom before the crisis of 1873, the current excitement surrounding AI, and the timeless lesson that technological progress and investment returns are not always the same thing. The future may indeed belong to AI, just as the future belonged to railways, automobiles, electricity, and the internet. But investors must remember that identifying a transformative technology is only half the battle. The other half is determining which businesses will ultimately create value for shareholders, and what price is sensible to pay for that opportunity. History suggests that these are often the hardest questions of all. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.